Imagine owning an exclusive money-printing machine, a business that serves over 5.5 million passengers every single day in the most bustling city on Earth. You have no direct competitors, no fear of being replaced by artificial intelligence, and customers are forced to pay before they even touch the service. It sounds like the ultimate entrepreneurial dream, a goldmine that any venture capital fund on Wall Street would desperately crave. We are taught from a young age to look for high-volume, captured markets where demand is guaranteed and the barrier to entry is practically insurmountable. On the surface, a metropolitan transit system checks every single box of a legendary economic moat. But reality has a way of slapping the illusions right out of you. In the world of transit economics in America, the conventional laws of business break down completely. This is not a place where billionaires are made. This is a massive, relentless money-grinding machine where the more customers you have, the heavier your losses become. It is an upside-down financial universe where growth is a liability, efficiency is an uphill battle against history, and without billions of dollars in emergency government bailouts every single year, the entire system would collapse into absolute chaos within 24 hours. To understand how such a massive paradox exists, you have to look at it through the eyes of someone who believed in the textbook definitions of market efficiency. Arthur was a highly successful tech sector sales executive, pulling in a reliable $115,000 a year. He lived the classic American suburban professional life, driving a precision German luxury sedan, tracking his net worth on clean spreadsheets, and letting his capital accumulate quietly in standard index funds. Like most corporate high earners, his financial worldview was shaped entirely by mainstream investment articles, quarterly earnings reports, and the clean, predictable margins of software-as-a-service models. To Arthur, business was an equation of customer acquisition costs, lifetime value, and scalable infrastructure. That comfortable, detached perspective changed on a rainy Tuesday morning when a routine transmission failure forced him to leave his vehicle at a dealership and step down into the subterranean world of heavy rail transit. It was an environment he hadn't experienced in years. Standing on a packed, humid platform, watching 500,000 commuters funnel through the turnstiles every single hour, his sales instinct immediately began running the numbers. He did not just see a crowd of tired people trying to get to work. He saw a captive market processing 5 million distinct fares a day. At a sticker price of $2.90 per tap, the top-line gross revenue projection looked staggering, crossing $14 million every 24 hours. Assertively, to a corporate professional accustomed to scaling software margins, where serving an extra million users cost almost nothing, it appeared to be an absolute friction-free monopoly, a mega cash-printing megastructure hiding directly beneath the metropolitan asphalt. Triumphantly, Arthur returned home that evening convinced he had discovered the ultimate macroeconomic blueprint. He sat at his desk late into the night, operating on the foundational assumption that high-volume consumer utilities possess an unbreakable economic moat that protects capital better than any trendy technology platform. Determined, he began looking for ways to expose his personal investment portfolio to large-scale logistics and commercial transit real estate, believing that immense infrastructure volume was the historical shortcut to permanent wealth preservation. Ominously, he viewed the sticker price of admission as pure, unadulterated cash flow, entirely blind to the hidden matrix of structural liabilities waiting to crush his capital. But as Arthur initiated his due diligence and began digging into the actual financial reports, he tripped directly into a high-friction expense matrix that no private balance sheet could ever survive. When Arthur cross-referenced his top-line projections against the operational expense reality, his high-volume software optimization logic completely shattered. In heavy rail business model, gross farebox collections are not a metric of profitability. They are merely a baseline distraction hiding two distinct, highly synchronized layers of capital destruction. The first silent leak draining Arthur's projected $14 million cash machine was rampant fare evasion. In massive public networks, enforcing collections across millions of open access points creates a physical bottleneck that is nearly impossible to solve without turning a transit hub into a fortress. When tracking thousands of unmonitored turnstiles, emergency exits, and multi-layered platforms, fare evasion ceases to be a minor nuisance and functions instead as a multi-million-dollar tax, siphoning off up to 14.7% of top-line revenue before the capital can even hit a processing account. Arthur watched his clean software scaling theory break down against the unpredictable variables of human behavior and social reality. The second layer was the catastrophic reality of fixed cost rigidity, specifically tied to legacy systems maintenance. Subterranean transit networks do not operate on automated software patches or cloud-based updates. They run on non-standard 100-year-old mechanical assets that require continuous localized hand machining. When a track switch fails in a tunnel built during the First World War, or a custom rolling stock braking mechanism degrades, the spare parts cannot be drop-shipped from a digital fulfillment center or ordered off a modern assembly line. They must be manufactured manually by specialized technicians in proprietary machine shops, pushing emergency capital expenditures to an average of $18,400 per hour of downtime.
Simultaneously, the fully loaded labor cost structure was structurally locked by historic multi-year labor organization collective bargaining frameworks. Arthur calculated that transit operational staff, including legacy pension liabilities, comprehensive medical allocations, and mandatory overtime premiums, accounted for a staggering 72.3% of the total operational budget. Because these contracts enforce strict minimum staffing metrics independent of actual commuter demand, Arthur discovered the capacity utilization rate paradox. Running a 40,000-ton train set fully packed with workers at 8 in the morning or completely vacant at midnight costs identical operational capital. The model does not scale linearly. Instead, as capacity utilization increases past the maximum threshold during peak hours, the rapid mechanical friction accelerates asset decay, triggering an exponential spike in emergency capital expenditures. Arthur was witnessing a perfect inverse cash flow loop. The more volume the physical system attempted to absorb, the faster its underlying structural leaks drained the enterprise of total liquid capital. With liquidity evaporating from structural leaks, the question shifts from survival to engineered salvation. How do these modern giants escape immediate liquidation when their core product loses money on every single transaction? To decode the hidden financial lifeline of these heavy rail mega assets, an analyst must look far beyond the visible influx of physical passengers and isolate the spatial economics of transit-oriented development. Heavy rail monopolies do not operate as mere transport providers. They function as primary commercial landlords, leveraging absolute geographic necessity. In a stabilized transit system, the subterranean footprint is engineered as a commercial real estate matrix where every square foot before the commuter reaches street level is optimized under high-barrier corporate leases. These structures do not rely on standard retail agreements that you might find in a suburban strip mall. Instead, they deploy highly sophisticated triple net leasing frameworks that integrate low base rent thresholds paired directly with aggressive percentage rent clauses tied to specific tenant performance breakpoints. When a multinational retail tenant, a high-end coffee franchise, or a digital media operator integrates into a high-traffic terminal, the transit authority establishes a baseline minimum rent to cover fundamental exposure. Excitedly, the moment the tenant's gross sales velocity surges past the contractually designated breakpoint due to the sheer volume of foot traffic, the lease structure automatically triggers a mechanism where the authority captures an additional 12 to 15% of all top-line revenues. Because the marginal cost to the transit system of hosting an electronic advertising network or a micro-retail station is virtually zero, the net interest margins within this auxiliary commercial segment consistently hover above 75%. Furthermore, to insulate these revenue streams from volatile operational degradation, the Transit Authority mandates comprehensive common area maintenance fees, legally shifting the variable costs of subterranean heating, ventilation, security, and structural upkeep entirely onto the commercial tenants themselves. This commercial ecosystem is further protected by strict co-tenancy clauses inserted into master retail agreements. If a major department store anchor or a primary transport connector within the terminal hub experiences an operational shutdown or a prolonged delay, these clauses dictate that the remaining retail cluster can legally compress their rent or terminate commitments entirely. This reality forces the Transit Authority to balance asset diversification with extreme precision to keep occupancy rates above a critical 85% threshold. It's a brilliant, high-margin real estate play hidden inside a failing transportation network. Yet, when a financial forensics auditor executes a full balance sheet reconciliation on a system like the New York Metropolitan Transportation Authority, a sobering scale mismatch emerges. Disappointedly, even when retail utilization is perfectly optimized and every square inch of commercial space is generating premium revenue, total auxiliary commercial leasing and advertising revenues account for less than 3.5% of the actual multi-billion-dollar annual operational cash flow requirement. Dramatically, the ultimate structural savior keeping the entire heavy rail network from immediate liquidation is not the commercial tenant, nor is it the cash collected at the farebox. It is the ruthless legal implementation of dedicated tax allocation. The system survives because regional municipal frameworks conscript the surrounding surface economy by legislative decree, automatically siphoning a fixed percentage of local payroll surcharges, corporate sales transactions, and regional petroleum distribution fees directly into the infrastructure capital accounts. Within this design, an individual does not merely pay for the asset when they physically touch the turnstile with their transit card. An individual pays for the subterranean matrix when they purchase a residential property, fuel a vehicle at a local gas station, or process a corporate paycheck anywhere within the metropolitan boundaries. This dedicated tax architecture operates as the ultimate macroeconomic life support machine, converting a structurally bankrupt, high-friction utility into an unbreakable tax levy that is deeply embedded into the very survival of the regional economy. This multi-layered subsidy architecture keeps the system breathing, masking the structural flaws under a blanket of public funding. But when global systemic shocks hit and the baseline assumptions of human movement change overnight, even the most fortified state monopolies can trigger a corporate heart attack.
This macro bottleneck analysis brings us directly to the corporate autopsy of Yellow Corporation, a historic giant that once dominated American industrial transit and supply chains before cascading into absolute liquidation. Operating a hyperdense freight footprint spanning the entire continent, this logistics megastructure deployed thousands of localized terminals and processed millions of product tons daily. From the outside, the enterprise projected the image of an unbreakable monopoly, deeply embedded within the core physical mechanics of Western commerce. It was the kind of company that felt too big, too essential, and too deeply integrated into the fabric of the economy to ever fail. However, the underlying capital structure suffered from the exact asset-liability matching flaw that systematically threatens heavy rail infrastructure network configurations today. Yellow Corporation combined extreme fixed cost rigidity with a highly illiquid operational framework. Its cost allocations were bound to rigid labor agreements, historical pension fund structures, and escalating multi-million-dollar monthly interest payments on capital expenditure debt that could not be optimized, reduced, or delayed when broader economic shipping volumes fluctuated. Management attempted to scale their way out of compressed operating margins by aggressively acquiring regional competitors, operating on the flawed software theory that expanded volume would naturally dilute their fixed liabilities and improve efficiency. This aggressive scaling strategy became a fatal systemic trap. Instead of generating positive marginal cost efficiencies, the expanded footprint created a massive, hyper-complex physical network that generated exponential overhead and required immense liquid cash reserves just to patch continuous mechanical decay across an aging fleet. The moment a sudden macroeconomic slowdown restricted domestic commercial shipping volume, their asset-liability matching unraveled completely.
The short-term, highly volatile revenues generated from day-to-day shipping contracts could no longer cover their rigid long-term debt service obligations. Because their cost structures were legally locked by historic agreements, they could not drop prices to capture emergency volume without operating at a direct, catastrophic net loss. Nor could they shrink their physical terminal footprint without triggering immediate cross-default covenants across their entire multi-million-dollar debt portfolio. The sheer scale of the enterprise provided zero structural defense. It merely guaranteed that the final capital exhaustion would trigger an immediate multi-billion-dollar corporate heart attack that disrupted the entire national supply chain. This macro failure delivers an undeniable blueprint for any capital allocator. Expanding your operational footprint without aggressively restructuring and correcting underlying fixed cost vulnerabilities does not build an economic fortress. It simply engineers a larger, more catastrophic systemic explosion when the liquidity cycle inevitably turns against you. The wreckage of these corporate titans leaves behind a definitive blueprint for survival. To build an unshakable financial fortress, an asset owner must completely rewrite the rules of engagement and walk away from high overhead structures. To completely mitigate this extreme structural decline across his portfolio, Arthur executed a comprehensive balance sheet restructure, altering his entire long-term capital compounding architecture. He bypassed high overhead transit networks and complex logistics operations altogether, and refocused his remaining capital directly into automated premium commercial self-storage real estate facilities, leveraging his position through highly conservative banking arrangements. Arthur stabilized his leverage parameters by maintaining a strict 40% loan-to-value ratio on the tangible asset, ensuring that his mandatory monthly debt service obligations could be fully sustained even if the facility occupancy rate contracted to an unprecedented 50% during an extended macroeconomic cyclical downturn. When executing the master commercial property lease agreements, Arthur directly negotiated a non-negotiable co-tenancy clause into the documentation, protecting his cash flow by allowing immediate rent reductions if major corporate economic drivers adjacent to the facility faced liquidation. He shielded his net operating income from the inflation of localized utility expenses by locking down long-term management parameters that capped annual common area maintenance escalations at a flat 3% cap, while ensuring that any operational tenant growth beyond specific volume breakpoints generated structured percentage rent inflows directly to his ledger. This strategic alignment allowed him to compress his overall capital expenditure requirements and completely remove the vulnerability of fully loaded labor costs, union negotiations, or staff turnover rate dependencies from his daily operations. By controlling the property through strict 3-net guidelines, he ensured that variable operational expense inflation was legally absorbed by the commercial occupants, while he maintained pure net interest margin expansion. This is a clear illustrative example of how real-world financial systems actually function when you strip away the marketing gloss. Your actual results in any asset class will always depend on your specific income, expenses, structural returns, and investment choices. When you master the art of balance sheet engineering, you cease to be a mere market participant hoping for a favorable economic turn. You become the ultimate house that always wins. Analyzing the structural fragility of these massive transit networks yields a definitive economic truth. True financial control is never achieved by merely tracking the visible friction of consumer point-of-sale transactions, but rather by auditing the unseen macroeconomic architecture supporting the entire matrix from below. For the sophisticated asset allocator, navigating this complex landscape requires shedding the superficial illusions of top-line volume and committing exclusively to the cold, non-negotiable logic of deep ledger forensics. If you seek to uncover the hidden vulnerabilities in seemingly dreamlike business models in an era dominated by engineered illusions, consider following our channel. Subscribe now to analyze the structural data below in the comments and ensure your capital never steps into a hidden liquidity trap. We will audit the next empire shortly.